Hi, this is Hutch with BankingTruths.com, and I'm at my mom's house. It's the day before Thanksgiving, and I'm making you a video. Why? Because this subject matter is so important, and this is fresh, this is hot, and it's going away. So fasten your seatbelts. We're going to go quickly because I got family stuff to do. First of all, disclosures. All this information is general and educational in nature. You need to get your own individualized analysis, and you need to check with the appropriately licensed advisors before implementing any financial strategies, including stuff for your own stuff that you already have. That's tax, legal, insurance, investment. Get your own advice before doing anything. So in the past, the default was to defer taxes at this time of year as much as possible and to accelerate your deductions. However, because the debt to GDP ratio, and I'm talking not about your debt, but the national debt to GDP ratio, is at unprecedented rates. That 125 over there on the right is just a projection, but GDP is shrunken because of coronavirus, and stimulus has increased the debt. This may be crazy, higher than it ever was before. And if we look at the tax rates, the history of the top tax brackets, when it was close to this high in the past was at the end of World War II. You can see the top tax brackets were over 90%, and then they fell down to 70 and then 50. So even though we complain about 37 and 40, we're not even close to how bad it can get. And it's very important to know that the 2020 tax brackets were a temporary thing anyway. It didn't matter who got elected. In 2025, we were supposed to go back to the old brackets, the one on the left, compared to these. So the tax brackets we have now are a gift. And really, we have till the end of the year to absorb some of these more favorable positions where there's lots of arbitrage. And it's a use it or lose it by the end of the year. So that's why I'm getting in this video the day before Thanksgiving. So now the new default and everything, I've been doing tons of CPEs for my tax accreditation, and everybody's talking about accelerate tax at the end of 2020 and defer deductions. Why? Well, you want to accelerate because there's a Georgia Senate runoff coming in January of 2021. Now, they say it's a slim chance that the Democratic Party will win both Senate seats, but if they do, it's going to be the trifecta. Joe Biden as president, the Democrats control the House, and if they control the Senate, then there's going to be some major sweeping tax changes. There's probably going to be some changes anyway, but with the Republican Party holding the Senate, they're more likely to slow down a complete deterioration from everything we know. But what about 2022? What about 2024? So deductions erase income at the highest bracket. And if the highest bracket's going to be higher than what it is today, then maybe you want to defer, just maybe, and get your own tax advice. Maybe you want to defer deductions rather than accelerate them and accelerate tax. So again, it's all about these zones. On the right is where we are before that big ball drops in Times Square on 12/31. And this is where it was in 2017. The star here is because we don't know where the exact threshold is, but what we can see is there's some big differences here. And even up here, the differences aren't as big, but we're talking about much bigger numbers because I have clients that have income way up here and there's still arbitrage. So again, use it or lose it. So this is what I call an accelerate to shelter table. So it's actually a table justifying a Roth conversion, but I didn't want to make it simply about Roth because a lot of my clients use life insurance, whole life, or IUL as a proxy for Roth. And so the same concept applies as long as you're getting the same rate of return. The numbers won't be exactly the same, but this is a 20-year analysis period for a Roth conversion, assuming you get 7% if you convert to a Roth, or you get 7% if you stay in an IRA and you take money out later. What you can see, let's just look at this 24% bracket, or 22. This is where I said it was really favorable, right? So if you, let's just say, convert at the 24% bracket, rather than keeping it in an IRA and someday taking it out of the 28% bracket, well, you just naturally have 15% more money in your Roth to spend, even though it's the exact same investment. Well, what about 24 to 33? Well, you'd have 35% more money 20 years out. 43 going from 24 to 35. And way down here, We don't know what it's going to be, right? It could be as high as 35. Going from 35 to 39.6, it's not as big of a percentage, but it might be on a much bigger number. Somebody might do this with $1 million, like between whatever, 600,000 and 1.6 million of income. They might do this and get this. So again, you can see that there's a clear advantage. The numbers may not be exact, but there's an advantage to some early acceleration, and that's the whole point. And it's in these zones, so use it or lose it. Let's see. So how do you use it now? Well, is 2020 a low-income year for you? I know it is for a lot of people. They got laid off. They cut their hours. Business was down. Lost wages, net operating loss. There's some additional bonus depreciation for business owners, all these things. So we can absorb these favorable brackets by Roth conversions, which is what we just talked about, or something we call IRA rescue. So taking a withdrawal from an IRA, assuming there's no 10% tax penalty, and that's what we're going to tell you how to do in just a moment. How do we do this penalty-free IRA rescue? Well, if you're over age 59 and a half, there's no problem anyway. You just take money out of your IRA, and again, you accelerate income into those brackets. If you're under age 59 and a half, normally there's a 10% tax penalty on top of the tax. But the CARES Act calls for something called a CRD, a coronavirus related distribution. And that's a penalty-free withdrawal of up to $100,000 from your IRA or your 401k. Your 401k program at work has to allow for it, but many are if you ask HR. So who qualifies for CRDs? You have to qualify for this. So it's you or your spouse. If you or your spouse or a dependent gets COVID-19, you qualify. That's very, very easy. The second one is two things. You have to have adverse financial consequences as a result of one of these factors: being quarantined, being laid off, or having work hours reduced. That's pretty much everybody. Unable to work due to a lack of childcare. That's a lot of people. Reducing hours of a business you either own or operate. So any of these three conditions, which is pretty much everybody, and you have to have experienced some adverse financial consequences. Then you qualify for this up to $100,000 withdrawal from an IRA that you can use for whatever you want. You can always convert an IRA without any, you don't have to qualify, but if you want to take it out and put money into life insurance as your own bank retirement vehicle, you can do it that way. So when is tax due for these CRDs, coronavirus related withdrawals? So you have the option to include income either ratably over 3 years. So let's say you didn't take 100,000, you took 99,000. Well, you'd have 33,000 of income in 2020, 33,000 of extra income in 2021, and 33,000 of extra income in 2022, which is kind of nice. You spread it out so you're less likely to get up into those higher brackets. But if you had a horrible year and you can use up the whole bracket in one shot, you can take it all in 2020 to use that to use those good brackets. So you need to let your CPA know that. And also you have 3 years to pay back any CRD. So this is really kind of nice. You can do it and you can wait and see. So if you do it, you can put the money in there, you can keep it safe and liquid, and you would have to file an amended return in the future years. So let's say you did this and then you're just killing it in these next couple of years and you go, wow, I wish I could put more than 19,500 or 20,000 or 26,000 in my 401k. I wish I could put 126,000. Well, you can just pay back your prior CRD. Now, it wouldn't be a deduction for that year, but your CPA could file amended returns for those prior years and you'd receive a refund for that, the extra tax paid, that extra 33,000 of income here, and here, or the extra 99,000 of income here. That's how that works. So again, why would you want to do this? For this reason. Which way do taxes have to go? I'll let you answer that. And also, you want to be strategic about it, and you want to find these sweet spots in the brackets, see where you are, see how much of this you can use, and that's how much you want to do. Or if you're up here, it's pretty easy. Again, and this is not exact, this is assuming a very specific situation, a Roth conversion, 7%, taxes paid with outside money, and this is how much extra money you'd have by doing that. So stretch gone. Oh, so some people keep their IRAs as a sacred cow because they think I'm going to use it for the stretch IRA for my kids. Well, the Secure Act that happened right before coronavirus that really got forgotten about because of the CARES Act, the Secure Act basically got rid of the stretch. It's still available for certain exempt beneficiaries, like maybe your spouse, maybe people a certain age that are on a list of beneficiary, maybe people that are chronically ill or disabled. But otherwise, there's no more stretch IRAs, and the money's going to be forced out 10 years after your death anyway. So best to beat RMDs to the punch. And also there's no RMDs this year, but again, we're trying to accelerate tax, not defer them, so you may want to take some RMDs. The AICPA, I was just on one of their calls. They are recommending tactical bracket management, whereas before it's all about deferring. They are recommending that you kind of accelerate and sprinkle year by year to use up these good brackets. Sprinkle it over your lifetime. How do you do that? By converting to Roth or doing these IRA rescues and then putting them into a vehicle that won't get taxed again, like in life insurance. Roth offers no control, but ILITs do. That's an irrevocable life insurance trust. And so do certain life insurance policies that have some sort of beneficiary distribution agreement. And that's basically a death benefit that instead of paying this huge lump sum, because I know some parents are worried about, I don't want to give my kid $500,000 all at once. But if they knew that the kid would get, say, $30,000 a year or $25,000 a year for 20 years, now that's a different story. Is that right? Yeah, that's right. Then they might be agreeable to doing something like that. Not as much control as an ILIT, but it's a way to do it on the cheap. It's just simply a certain type of product. Well, 0% capital gains. That's a big deal. This has been around since before coronavirus, but most people didn't qualify for it. But you may qualify for it now, and here's how. If you're married filing jointly and you make $80,000, or if you're single and make less than $40,000, or married filed separately making less than $40,000, I think head of household was 53. But maybe this wouldn't happen before, but because of coronavirus, you may. Well, guess what? If you have highly appreciated stock, let's say you have stock, not in an IRA, but in a brokerage account that you've held for more than 1 year, instead of paying a 15% capital gains rate, you're going to pay 0. So that's at the federal level. You may still pay some state, but why not take advantage of that 0% capital gains rate for this year only? You got another 5 weeks to do it. Maybe if you're watching this in early December, you got 4 weeks or 3 weeks. But take a look. If you're under these thresholds and you have stock you've held for over a year, even if you love the stock, well, I bought this Facebook stock a long time ago and I want to keep it. Well, guess what? Maybe sell it, take the 0% capital gains, and buy an ETF or a stock kind of close to it in the same sector, a different FANG stock, to kind of represent it while you avoid the wash rules. And that's something you'll have to talk to your CPA about. It's how long you need to wait before buying back the same exact stock. But you can buy stocks or ETFs or mutual funds close to it, like the QQQ maybe. And again, this is not an investment recommendation. I'm just giving you a general example. So this is a planning opportunity for any adult family member. We usually think about it with kids, but some of us are in the sandwich generation where we're taking care of kids, and maybe there's parents we're concerned about, and maybe their incomes went down this year. Well, guess what? If you have appreciated stock you've held for more than 1 year, you can gift it to low-income adult family members. You can gift it downstream to kids. You can gift it upstream to parents. You can gift it sideways to brothers and sisters. And if they've made less than $80,000, you could really gift it to anybody, I guess, who you trusted enough, and they would pay 0%. Now, it's worth noting that the annual exclusion gifting limits is $15,000. But if you and your wife are married, you could do something called split gifts, and you can double that. You do have to file a 709. That's a gift tax return to just alert the IRS that you did split gifts, giving over $15,000. But $15,000 is kind of your line in the sand without any complication whatsoever. So this is stock that normally you'd have if you wanted to help out a kid who lost their job. Maybe they were just fresh out of college. They're adult kids. Kiddie tax rules apply. So kids that are in college and still under the kiddie tax rules, this won't count. They're going to be lumped into your tax bracket. But if they're young adult kids and they don't qualify for the kiddie tax, they have their own tax bracket and they've made less than $40,000 and they're single, maybe gift them $15,000 in stock. They can cash it out of the 0% tax bracket and use that as a way to help them. So let's talk about gain harvesting, not losses, for ultra high income earners. So usually this time of year, ultra high earners with big portfolios are talking about loss harvesting. They're trying to sell stocks and mutual funds that are down so they can sell the equal amount of winners to kind of rebalance their portfolio without paying any tax. But again, similar to, hey, maybe this is the year to accelerate tax. This is the year where you may want to do some gain harvesting. Sorry, this order is wrong. So it has to do with something called the Buffett rule. And it's because Warren Buffett said that he paid lower effective tax rate than his secretary because he was selling stock and she had W-2 wages. And he said, that's not fair. And people listened to him and they said, you know what? So maybe for people who are rich enough or make too much money, we should get rid of the 20% long-term capital gains rate and make that go to 39.6. So they're talking about $1 million, but there's also a lot of rhetoric about anybody making over 400,000. Who knows? But perhaps it's better to harvest these gains and not losses in 2020. Do it now. What if this thing goes away in 2021? Really depends on the Georgia Senate runoff in early January. Unfortunately, we won't know what to do in December because the answer is going to come in January. If only there was a way that we could sell our appreciated stock in December and then nullify that transaction in January if in fact it was a false alarm. Guess what? There's a way. It's called going short against the box. And what I love this with my ultra high net worth people with estate planning, we find a lot of these opportunities in the tax code. It's things that the IRS did to stop something that they deem unfair over here, but we get to use those same rules in estate planning and have it work for us. And this is one of those examples. So let me give you the history. In the late 1990s, the tech bubble had inflated. Remember everything, all these companies, the dot-com bubble that didn't have any earnings were going crazy. And so people were getting these crazy gains, 100, 500,000% gains, and they hadn't even held it for 12 months. And so what people did is they would hold the actual stock certificates inside a safe deposit box, hence going short against the box. And they'd have them less than the 12 months to get the long-term capital gains treatment. And they wanted to lock in the gains. They'd already made enough money. They were worried about the bubble popping or, something else was hotter and they wanted to get into that. So they wanted to lock in their gains. They wanted to defer tax maybe from 2020 to 2021 because back then it did make sense to defer tax. And again, they wanted to get to 12 months for long-term capital gains treatment because short-term capital gains is already at that worst ordinary rate. So what they do, they'd have the stock certificates in their box and they'd simultaneously open up a short position for the exact same stock in a brokerage account. So let's say they had 100 shares of AOL inside their box. Well, they'd keep that, they were long that, and then they'd sell short inside a brokerage account the same 100 shares. Selling short typically means you're betting on a stock to go down. But since they're already long, all they did is they just made themselves perfectly hedged from that point forward, and they did it just so they can run out the clock. So they can delay the holding period, get to 12 months, they can defer tax into another year, and they can turn it from short-term capital gains into long-term capital gains. And the IRS stepped in and they said, wait a second, you guys are clever, but this whole shorting against a box, this is just a constructive sale. So we're not going to allow it. If you do this, we're going to deem that a sale when you went short against the box. Well, wait a second here. What have we got? Well, IRS, you can't have it both ways. So what you can do, let's say you have that 100 shares of Facebook or Amazon or whatever it is. Again, not a recommendation. So you could sell the exact same stock in December. Let's say you have the 100 shares. You can sell the exact same stock. You can do it in a different brokerage account so it doesn't automatically sell you out because then once you do that, it's over. Like you've sold out and there's no going back. But there's also a way, and you need to contact your broker, you just sell to open rather than sell to close a position you already have. You sell to open a short position in the exact same stock. Now, what it'll do, and this is the only downside of the whole thing, is it'll freeze your gains from December into sometime in January. So if it's Facebook and you sell it short and you have your 100 long and your 100 short and it goes crazy good, well, guess what? You're not going to make any part of that crazy good. It kind of helps you if it goes down, even though you're perfectly hedged, because Before, if you were just long and it went down, you'd lose money. Well, now, your longs went down, but you're making profit. So again, you're just freezing. Whatever you made on that day that you sell to open, you're just totally hedged. So that's the only downside, is if things go up, you don't get any more run up. But what it does is it gives you an opportunity to wait for more language from Joe Biden and also to see how this Georgia runoff goes. So it's a wait. It's that the whole strategy is just a wait and see up to 30 days in January. So you need to keep this long enough to figure out what's going on in January, because if you stay short, then it's considered a constructive sale in December. So basically, if you hold the short open for longer than 30 days into January, then the IRS will say, oh, you're going short against a box. We're deeming that a constructive sale in December. Well, guess what? If they change the long-term capital gains rate from 20 to 39.6, whoever you are at whatever level, you might say, well, wait a second, that's fine. Just pretend I sold it back in December. Now, if they don't change it and you say, okay, you know what, I like my Facebook stock or whatever it is, Amazon, I just want to keep it. I know I missed out on any gains between December and January, but if you remove the short up to 30 days in January, then it's not considered a constructive sale in December as long as you hold it for at least 60 days after that. This is crazy advanced stuff. Do not try this at home. Verify with your CPA how to do this correctly so you can truly wait and see and have that wait and see opportunity. And so that with the holding period, you don't cause yourself a constructive sale if you don't necessarily want it once you find out what happens in January. I think that election is early January. It might be nice to hear some more rhetoric from the president-elect. And also, when you do it, you need to verify with your broker that the stock sale, when you do that short against a box, that it's a sell to open order creating the same short position and that you have both positions simultaneously. Your long that you already held for more than a year, right, up to that point, and the simultaneous short sale at the same time. You need to hold them both. And it's very important that when you do sell, you don't do a sell to close the order, because that'll just automatically, now you sold it in December and you have no wait and see, you have no options. You just sold in December. In which case, if you want to, great, you locked in the 20% long-term capital gains, hopefully. All right, so let's move on to estate planning concerns. There's lots of them. I could go on for days here, but I'm not. What I will tell you is for estates between 7 million and 23 million, this is really scary stuff because the estate planning exemptions were so high. They were over $23 million this year. So people didn't need to worry how big their estate was as long as they were well under 23 million. But I have a lot of clients that are somewhere between the 7 million and 23 million. Guess what? It's time to worry. Why? Because they're talking about bringing back the estate tax exemptions back to the 2009 level, which I believe was 3.5 million per spouse, which means for estate more than 7 million, even if you're not there now, but you think it's going to grow past that, guess what? You now got a new silent partner in the deal. You already did anyway with income tax. You already have a silent partner with everything you're doing. Now you got an additional silent partner. You just gave away another third to the estate tax. And that's the other thing. They're talking about raising the actual estate tax rate. We'll see what actually happens. The nice thing is the IRS has said that the $23 million, which you could use when you die or you could gift it in advance, that the lifetime gift exemption, they will not claw it back. So again, we have another use it or lose it situation. So you have $23 million right now of gift tax exemption that you can use before things change. Now I realize it doesn't give you a lot of time to figure things out, and people get very nervous about gifting to irrevocable trust. Just the word irrevocable makes them nervous. But we have a lot of estate planning tools in the toolbox that are probably going away. We have a whole set of power tools right now between all kinds of stuff, and pretty soon it's going to be going to like a hammer and a nail and maybe a screwdriver. We'll see what happens. The other thing is step up in basis in question. It used to be if you die with that highly appreciated stock, it would just step up in basis. So if your kids got it, they would inherit it at not the basis you bought it for, but whatever basis it was at the date of death. so they could sell it tax-free. Guess what? That could be going away. And this is what I was talking about. There's a lot of estate planning tools on the chopping block. Lots of stuff, valuation, discounts, grantor trusts, idiots, lots of stuff that may just be going away. Grats. But the problem is estate planning attorneys are incredibly busy right now, like crazy busy because of this. So you're going to have to get in line with them. This is an opportunity. We actually do consult on this, sometimes on an hourly basis for very complex situations, to give good ideas and get people's heads straight before they go in and go on the clock with the attorney, which is usually going to be a flat fee and a little bit more expensive. You obviously need to do this work with the attorney. Why do you want to do it? Here's why. This is just the income tax rates, not even talking about estate tax rates. And here again, there's these opportunities. So what's next? What can you do? Well, for potential clients, you go to bankingtruths.com/tax. I believe this video is on that page. And if you scroll down, there's this whole schedule link. You can put in your information. We're happy to have a conversation to see if there's a fit to do something, whether it's some of that IRA rescue into insurance, whether it's some of this planning, whether we discuss it hourly, however that works, we can have a conversation and see if there's a good fit going forward. For fellow advisors, two things. We have bankingtruths.com for advisors. It's a free newsletter. And also bankingtruths.com bundle. We're building software. We also have a lot of training videos. We do hourly consulting for advisors, but we don't do free consultations for advisors unless they're part of a training, in which case we do group calls. And I believe there's going to be one in December for the people who purchase this bankingtruths.com bundle, which is very cheap right now. We're going to have software that won't be so cheap in the future, but right now the bundle comes with a trial, and I think it's like $109 or something like that. So hope you all found this helpful. I know it's Thanksgiving. Enjoy your holiday, but then come back, devote a little bit of time. You work hard for your hard-earned money, and you don't necessarily want to just give it away due to efficiency and lack of knowledge. So take a look and see what opportunities can be gleaned from this, and let us know how we can help. Happy Thanksgiving all.